Today, we will talk about understanding hung convertibles. Hung convertibles are convertible securities where the share price of the underlying security is well below the conversion price, making it unlikely that the securities will be converted into common stock. Since unconverted securities must be repaid at face value, most issuers wish to prevent their convertibles from being hung. Convertible securities are a type of bond, note, or preferred stock that can be converted into the common shares of the issuing company at a fixed price and date in the future. Many companies with low credit choose to issue convertible securities as an inexpensive way to raise money. When convertible securities are unlikely to be converted to stock, they are referred to as hung convertibles. This is most common when the cost of conversion is greater than the price of the underlying stock. Due to their limited prospects for conversion, hung convertibles, also known as busted convertibles, trade more like debt instruments. Hung convertibles can take the form of bonds, which are backed by collateral, or debentures, which are dependent on the promise of the issuer to pay its obligations. For example, consider a convertible debenture with a face value of $1,000 that can be converted into 100 shares, for a conversion price of $10. If the price of the underlying stock is $4, this debenture would be considered a hung convertible, especially if it matures in a relatively short period. To solve the problem of a hung convertible, a company would need to improve its fundamentals, such as revenue growth, operating margins, or return on invested capital, to spur the common stock high enough to reach the conversion price. Some investors view hung convertible securities as the best of both worlds. They have the income-producing and stable price qualities of a bond plus the conversion feature that can provide the potential to gain shares of common stock. In other words, an investor gets paid to wait by earning coupon payments up until maturity or conversion into common equity. Hung convertibles come with drawbacks as well, paying lower coupon rates than bonds of the same maturity and credit quality. And if the stock of the issuer performs poorly, the investor will be left with a lower-paying bond. Valuing convertibles is a complex exercise since factors that impact bonds, such as interest rates, and factors that impact stocks, such as earnings growth, must be analyzed in tandem. When a convertible bond is trading close to its investment value, or the value of an equivalent non-convertible bond, its price behavior will be more influenced by interest rates than one trading closer to its conversion value. In general, however, a change in the fundamentals of the issuing company will have the greatest impact on a convertible's price. Here are 5 key takeaways. 1. Convertible securities are securities that can be repaid in money or the stock of the issuing company, with certain conditions. 2. Hung convertibles are convertible securities where the share price of the underlying security is well below the conversion price, making it unlikely that the securities will be converted into common stock. 3. Due to their limited prospects for conversion, hung convertibles, also known as busted convertibles, trade more like debt instruments. 4. Most companies prefer not to have hung convertibles, since these obligations must be repaid in money. 5. To solve the issue of a hung convertible, a company would need to improve its fundamentals to spur the common stock high enough to reach the conversion price. Hope this would help. Thanks for watching.